tools of monetary policy. If the cash rate target is an objective, it's a target, it's not a tool, so what are the tools then? What are monetary policy tools? We will distinguish between tools of monetary policy and target, knowing that the cash rate is a target, and we will explain open market operation, lending deposit facility, reserve requirement, and then we will explain the auction that the RBA is doing every single weekdays to inject central bank money in the economy. And what we are going to show is that when we speak about monetary policy, most of the time, what is changing with monetary policy is central bank money, not big M. Big M moving with monetary policy is a shortcut. So let's go to the distinction tools, instruments, and target of monetary policy. So the best way is to think of monetary policy in terms of what can be changed and how it propagates until it reaches its objective. And the objective of monetary policy, what we call the final target, the final goal, is inflation, employment, production, and growth. You see the asterisk? Asterisks refer to what we currently use in Australia. Inflation is our target. We don't have a target about growth. What can the central bank manipulate? The cash rate is not a tool of monetary policy, because the cash rate is a private interest rate between a private bank and another private bank. They do what is the best for them. So if they decided that they need to put an interest rate higher than the target or lower than the target, they can do it. What we call a tool is something that if the central bank decide, it happens. It's their choice. An obvious one is the volume, and again it's an asterisk because that's what we do in Australia and in most countries. What they control is how much ESF they inject on their open market operation every day in the auction. In other countries, it's not the volume injected, but the interest rate of the open market operation. That could be what they decide. The other thing that the RBA is controlling is the discount and the lending rate. What they choose for the cash rate target is going to influence what they decide for the discount and the lending rate. Lending rate, discount rate is the rate at which commercial bank can borrow money from the central bank in a way that is different from open market operation. Banks can have reserve from three sources. They can have reserve from another bank in the interbank market, or they can get at the auction for the open market operation, or they can have it if there is an emergency from a lending facility. So the difference between the two sources of reserve coming from the central bank is who decides the volume. If it's the open market operation, the central bank decides, and we will see that the price, the interest rate, will be decided by the auction. But when we go to emergency lending, now this time who decides the volume? It's the bank in trouble. Whatever you decide, I give you. What does the central bank control as a tool? It's how much they are going to pay as interest for that. So this time the tool is the interest rate on this emergency lending, when in the normal open market operation, it's the volume injected that is the tool. Deposit facility rate, again, it's related to the cash rate target. When the central bank has chosen the cash rate target, it also gives a value for the deposit rate. So basically, once you have the cash rate target, the discount rate is cash rate target plus 25 basis points, and the rate for the deposit facility rate is cash rate target minus 25 basis points. The deposit facility is simply having a bank account called ESF, and the rate is simply how much the commercial bank receives as interest overnight for having money in the ISA. Reserve requirement, banks have to hold ESF, central bank money, as a proportion of their deposit, and this number, this ratio, is decided by the central bank. So that is also a tool. Okay, so that is what the central bank the RBA can control. The volume of the injection in the daily open market operation, the interest rate on the discount lending rate, the lending facility, the interest rate on the deposit facility, and the reserve requirement, how much they want banks to have reserve. That is their decision. what happens is those tools are going to have an effect on the interbank market. And as soon as it will touch the interbank market, it will affect the cash rate. The cash rate will be the price that banks lend to each other. It's a contract between two banks. But what the central bank has done here will influence it, will make it move. And the question is then to have a target for that. So we know the cash rate is moving by itself because of the private banks, but the central bank is trying to make it go where it wants it to be. The cash rate target, in the old days and still in some emerging countries, one of the targets would be the total amount of bank reserve. The central bank would announce or not announce, but have a target for how much we want bank reserve to have. And that has been the objective that many banks had in the past. Then this will have an effect on money supply, so the big M. Between a monetary policy and big M, there is a lot between. The red box is what we are not telling in a basic macro books, but is actually what is happening all the time, every day. It's this interaction between tools and cash rate, and that then, only after that, affect big M. And it can take a long time before it affects big M, by the way. What we call the intermediate target, it's intermediate because it's between the beginning and the end. The end is inflation and growth, and the beginning is the tools. So it's somewhere between. It's after the cash rate, but it's before the inflation. Intermediate target would be either the money supply, but nobody cares anymore. More importantly, the longer-term interest rate. So typically, what is the yield on a 10 or 20 years corporate bonds? That will be really what matters. So they may not have a target, they may not have a number that they announce, but they check on it all the time. If they want to stimulate the economy, they want the interest rate to be lower for the corporate bonds. Why that? Because they want company to borrow and do investment. The fact that there is in your textbook all this big deal about the money multiplier is simply the reminiscence of the fact that in the old days, money supply was the target. But nowadays, what matters is the long-term interest rate. Three instruments, I've already said that, be careful. The cash rate target is not a tool, it's a target. It's a decision of the central bank, but not for their tool, but a decision for what they are trying to achieve. Open market operation. Open market operation means the central bank purchase or sell a security, and that would necessarily change ESF. So it's an exchange between security, ESF. I take the security, I give you ESF, or the other way around. I give you a security and I withdraw ESF, because a central bank cannot take ESF. It cannot be an asset for them, it's a liability. If the ESF are leaving the commercial bank, they cannot go into the central bank. They can only disappear. In Australia, open market operations are actually only made with banks. So personally, I would not call them open market operation because it's very closed private market with banks between a central bank, the RBA, and commercial bank, and that's it. That's a bit different from the US because in the US, they can do open market operation mainly with banks, but they can do it also with primary dealers in government bonds. So those companies who are in charge of trading bonds, in this case, it's really open because if you accept the primary dealers that are not banks, that's very important because you will see that if there is an open market operation with a non-bank primary dealer, then actually big M in your curve in the macro book is going to change as well. But I would really want to insist that that is not the most important. The most important is what banks do with the central bank, and that is not M, it's ESF. Most open market operations are repo. Repo means repurchase agreement. It means that when the bank buys the security from a bank, they already agreed to do the opposite 2 weeks after, most of the time, or 1 month after. So basically, when they do the purchase, they already organize selling back. to the same bank. So it's two transactions in one contract, if you want. It's like having a loan, because when you think about it, the central bank buy a security, give ESF, but they already agree that the ESF will come back, and they will come back in a bigger amount. So it's like an interest on a loan. So a repo is like a loan, except that the collateral, which is the security, is actually moving inside the balance sheet of the lender, which normally a collateral doesn't go to the lender. You know that. List of eligible security for doing that. So what you can exchange with the ESF can change from country to country, but what they all have in common is government security. Every country will have their own government security as part of what you can exchange for ESF. So that's the repo. You see that the bank give away a security, but later on they buy it back. And they buy it back more expensive than they sold it, so they pay an interest. The RBA create money when they buy the security, and they destroy central bank money when they take it back. That's a repo with a bank. If you do it with a primary dealer in the US that is not a bank, look what happens. The Federal Reserve have more security, more federal funds. Fed funds is the name for ESF in the US. What you see is in the bank, you don't have less security because it's not them who sold the security. It's a primary dealer, and the primary dealer has an account in a bank. So when the primary dealer sells government bonds to the central bank, the deposit account of the primary dealer goes up, and then the bank receives federal funds from the central bank. So here you have a creation of money, but you don't have a decrease of security. But that is marginal. Most of the operations are done with banks. The main story is we deal with banks and we increase ESF, or we increase federal funds. In Australia, we don't have enough government security. So if we want banks to be able to come to the open market operation every day, we need to accept that they are bringing something else. And what they can bring is bank bill, bank issued bonds, commercial deposit, foreign currency. There is a principle of third party. It means that if a bank brings a bank-issued financial instrument to the open market operation, it can't be their own liability. It has to be the liability of another bank, because if it's the liability of another bank, it's an asset for them. Open market operation is about liquidity. A bank gets rid of an asset to get ESF. If they were coming with their own new product that they have issued on the liability side, it will not be liquidity, it will be funding. ABCP, RMBS. So during the financial crisis, they would even accept securitized product as part of the monetary policy. If they had to offer it, they had to prove that the loan that was in the ABCP was not their loan. Again, the principle of third party. During the financial crisis, they extended the list of eligible. They extended so much because they were so keen on making sure that bank could bring something. So that's the auction. Bank bring government security that have been issued in the past. So it's a secondary market device. It's not the real secondary market with dealers. It's a special closed secondary market just for the banks and the central banks. So every day at 9 a.m., the central bank announces the amount of ESF they are going to inject. Then the banks have 15 minutes to say what they want. So they have to give pairs of quantity of ESF, interest rate they are ready to pay for the repo. Then we aggregate all the demand of ESF by banks. We superimpose the supply. Then you find the intersection. It's normal because they are trying to have a loan. So we always make win those who are desperate. They are bidding a higher interest rate. You give priority to those who show in their bid that they are keener, they are more desperate to have it. It's a discriminatory auction. At the end, everybody who wins pay only the interest rate of their bid, but the market clearing one, when I say market clearing, it's auction clearing one, would be the threshold to decide who wins and who loses. Every day, the RBA is showing on their Excel file on their site what was the result of the auction. So you can see it the same day. I went to check for Monday what it was. So on Monday morning, you see how much they wanted to inject. That's what they really injected, a bit more than planned. And it was repo. And then you see what was the result of the auction. Actually, what they have done on the 15th last year, but here on Monday, they did 2 auctions for 2 different maturity of the repo. One repo was 17 days. What does it mean, a repo of 70 days? It means that between the moment the RBA buy and resell, there are 17 days. So it's like a loan for 17 days. And they did a second one for 32 days. So there were 32 days between the moment the bank sold the security to the central bank and the central bank sold back. And each time you see what is the cutoff and you see the average of those who win. Where does it come from? It's every winner interest multiplied by how much they have bid. So you weight by the quantity of the bid. So you take the interest of the bid of the winner and you multiply by the quantity, and you do that for each of them who win. The deposit and lending facility. The lending facility, it's not the open market operation, it's where commercial banks borrow from central bank, but it's for emergency reason, and therefore there is no limitation of what they can get. They can get as much as they want. What they have to pay is imposed to them. It's not an auction anymore. You need to pay cash rate target plus 25 basis points. For 1 day, by the way. The emergency one is for 1 day. So it's 2 separate things. There is the open market operation where you borrow what the central bank wants to inject, and then there is the one where you ask as much as you want, but usually you pay a higher price for that. There is also the deposit facility, so that's how much you remunerate the current account. And you know, in all countries, they remunerate the current account of a bank at the central bank. For us, it's 1.50 minus 25, so we give them 1.25 on their balance every night, a yearly interest rate, so yearly divided by 365 to know how much interest they got for 1 day. In the US, they didn't have that. So that's quite surprising. In the US, when banks had a balance in the central bank account, they were not receiving interest. And during the financial crisis, as an emergency, they introduced it. Reserve requirement. All countries have reserve requirement as a percentage of domestic deposit. In all countries, there is a lag. What it means is that you ask banks to have reserve, let's say now, for deposit they had in the past. The reserve are after the deposit. And the other thing is that in both cases, you do an average. So in order to know how much reserve you need, you calculate your deposit over a certain period of time and you do an average. And to know if you are meeting the reserve requirement, you do an average of your reserve for a certain amount of time. In Australia, since November 2013, we have reserve requirement, but they are not a percentage of domestic deposit. Banks are just told you are going to have this amount of a reserve. You can't touch it, so you can't use it for payments. You increase the demand for reserve for banks because it's amazing how suddenly from 1 day to the other, around November 2013, you see the amount of ESF changing volume like crazy. Thank you.